such a pleasure to be back with you right here on the India Development Debate. I'm Supriya Shrinate. And on this edition, we put the spotlight on the macros, the effort to reboot the rupee. And why is it that markets continue to sulk? Over 500 points down for the Sensex, the rupee continues to be at levels of 72.5 despite the rescue act by the government and all efforts to reboot. What is it that the markets are suspicious and perhaps uncomfortable about? Let's take this across to an expert panel that's joining us right here. I've got Jahangir Aziz joining me. He's head of emerging market Asia for JP Morgan. I've got Mr. S.K. Ghosh, Group Chief Economic Advisor, SBI, and of course Ms. Shobhana Kamineni, former President, CII, and Executive Vice Chair, Apollo Hospitals. Thank you each one of you for being with us. And Jahangir, if I may actually begin with you, the measures that have been taken by the government as far as arresting the rupee's fall and strengthening the economy and macros are concerned, do they show that the government is proactive in control, or do we risk sending out some panic signals here?
Look, I think, the reaction to the rupee, I think, is misplaced in the sense that, rupee is just a symptom. You alleviate a symptom, in this case by, FX interventions to smooth out the volatility. But you don't really address the symptom. You address the cause of the symptom. And I think, as we have spoken earlier, I think there are two separate causes. One, of course, is the rising current account deficit, and the other is the tightening in global financial conditions. And I don't think there is very much controversy about either of the two. I think the question is, why is the current account deficit rising? And I think here we differ somewhat from other people's way of analyzing things. We don't think it's a matter of exports and imports. Rather, we think it's a matter of saving investment imbalance in India. To put it differently, the fact that the current account deficit is rising is essentially a mirror image of the fact that the investment pickup that we've seen over the last couple of quarters, there isn't sufficient domestic savings in India to fund it, which is why that investment needs to be funded abroad. I think that's the domestic problem. I think on the international side, obviously, there has been a rise in or tightening in global financial conditions from April, May, June, July. I think in August it was somewhat different. That in August there was a reassessment of emerging market risk, particularly emerging market current account deficit countries. And I think the market has been asking for a higher risk premium, not just of India, but across everyone else. And I think the question that needs to be asked is whether India should respond to the lack of savings or the decline in savings that has taken place and the global tightening in global financial markets, rather than say that should we respond to the rupee.
Okay, Shona, if I may come to you, a lot of people here believe, and one of the experts on our channel said, this is nothing but the government really looking at ways to finance the deficit. Are you going to be as uncharitable, or do you believe that's the realistic way to look at this? I mean, why did the government have to announce these measures? Just will attract $8 to $10 billion. People believe these are half-hearted, and which is perhaps also the reaction. What explains the reaction we saw both in the markets as well as the currency markets on this count? Is this merely a way to finance the deficit, and is that why, stakeholders aren't impressed?
I think, see, the steps which has been announced by the government at the first place on Friday, I think these are initial steps, but to be very honest, I think these steps are the markets, and today the markets, the way it has reacted today, I think the markets believe that more steps are going to come, and the steps which have been announced, I take your point, because this year the financing of the current account deficit is a problem, because there is more of debt creating flows. In our analysis, debt creating flows will possibly outpace the non-debt creating flows in terms of financing the current account deficit, which is never a healthy sign for any economy, because that goes out at the same extent which it comes in. So from that point of view, this measures is possibly in alleviating the stress in terms of attracting capital inflows. But I believe that these steps are mostly long-term in nature. For example, if I just give you a very specific examples on the masala bonds, I think yes, it's an excellent step, but masala bond, if you look into the number of issuances, there is almost no issuances in the last couple of months or even in the current fiscal year. And given the fact that the rupee is now unstable and the hedging risk comes onto the investors, so that means that masala bond as of now looks unattractive. So from this point of view, and also the same case with the ECB one and the other steps which the government has announced, has said or intend to announce over the next couple of days. So my sense is that the market is now waiting in the looking in the forward direction to see if any measures, operational measures possibly, which comes from the central bank, because at the end of the day the central bank also needs to communicate to the market that it may possibly looking at some other options in his arsenal so as to ward off this foreign currency crisis, and maybe that's one way to look into this why the rupee depreciation weakness still continues. Because apart from the global problems which Jahangir just mentioned, I would also add that the sentiments are very weak, and maybe the market perceives that these steps may not be just enough to fight off and rupee depreciation effectively at this point of time.
All right. You know, the sentiments are weak and these measures may not be enough because a lot of how the rupee is reacting is on account of global factors. But let me just take this quickly across to Shobhana Kamineni. And Shobhana, specifically on the ECB really, you know, the measures that have been announced are aimed at bolstering the capital account by luring inflows. There will be a short-term increase in ECBs. Many people are again questioning that, was it warranted because there is enough funds available with banks to lend. FII exposure in fact could worsen in effect the risk profile of companies by increasing unhedged exposure. Can India Inc. afford this sort of a risk when recovery is just very, very nascent? We are seeing the first few signs. Can we afford this vulnerability?
See, I think it's important for us to kickstart new capacity building. And FPI having come in all these years and now having a shortfall, the government stepping in and bringing in measures like the ECBs and allowing manufacturing companies with, you know, to raise up to 50 million you know, on an annual basis. I think that those are positive, because what it does is it removes this almost, you know, the large amount that we have to do for hedging long term. So I think that we can get it at favorable terms. Indian businesses know how to raise this and be more proactive. It's just another source, and we need to move towards this. So we are positive. In fact, a survey that we had done for I mean, with our CEOs, with almost 70 CEOs that participated in this, showed that many of them, 47% of them, were looking at creating new capacity. Another 40%, so that's a huge number, were thinking about expansion. So when you see all this, you have to create new means to finance this.
Okay, so these are new means to finance expansion. We are seeing the first few signs of capacity utilization, credit offtake, GFCF rise, and I think Ms. Kamini is really pointing out to the animal spirits in Indian industry that need to be unleashed. But Jahangir, you know, the counterpoint to that is that the ECB tweaking will boost short-term capital inflows, but there are those who worry about the mid to the long-term vulnerability that this imports in. We've seen FPI outflows to the tune of $1.3 billion in September alone, $8.5 billion outflows in the first quarter of this fiscal by the FPIs. How worried are you on that count?
Look, I mean, you know, when these restrictions had been imposed, they had been imposed on the grounds, and I think that's the right ground, that these added to the macroprudential regulations that were needed to safeguard India's external vulnerabilities. You know, so, you know, when they have been eased, the question is, are they being eased just because we are under pressure, or does the RBI and the government think that those macroprudential regulations or the macroprudential regulations are no longer required? Look, I mean, I haven't heard anything from the government or the RBI to say it one way or the other. So it's difficult for me to say, well, this is being done because today they feel that those macroprudential regulations are no longer required.
Shamil, you know, the other question is that most of these measures put together, and we put forward this question to the Finance Minister and also to the DA Secretary Subhash Chandra Garg, most of these measures put together will attract anything between $8 to $10 billion. You've got Forex reserves of $400 billion. Why do you need money like this? I mean, you know, because the cynical way to look at this is that you've got so much money here as Forex reserves, you don't want that to deplete, and you're resorting to short-term borrowing.
See, I think I will just put the answer, I will put the question a little bit differently. I think I'll just give an historical perspective. I think the 8 to 10 billion figures which the government is saying, this possibly is a long term which it is actually thinking about. I'm not sure about the number, but I think possibly the government has something at the back of his mind and is saying over a period of time. But if I just compare it with the foreign exchange reserves as of now, I think it has just dipped below 400 billion reserves. I think one way to look into this problem is there are two things. The first thing is that I think in a situation when the currency continues to be volatile and given that all emerging economies face risk, so I think the RBI understands that spending reserves is unlikely to benefit much, so let the rupee find its natural level because there are costs associated with such intervention, and this has been very implicitly stated by the RBI in the recent annual report, and that's why you will see that the intervention has actually declined in the last couple of months. However, there is also another side to the story which I'd like to mention. If you look into the all currency crisis in India beginning from the 90s till 2018 latest date, and if you take the foreign exchange reserves at the beginning of the crisis and the total amount of RBI intervention in the foreign exchange market as a percentage of foreign exchange reserves, I think this time the number comes to around only 3.9%. That means only about, I think, as per the latest data of July 2018, only 16 billion of the RBI reserves possibly were used up to defend the currency out of 420 odd billion which was at the beginning of April 2018. So my sense is that if I look into the average of all these last 25 years, the average comes to anywhere between 8 to 10%. So that means the RBI has possibly enough firepower even from the current level of reserves to go and defend the currency. So there are both sides of the story. Whether you want to if you want to defend it, there are costs, but there are reasons to defend it because historical experience actually shows that in the proper context.
Okay, fair point indeed. I want to shift the debate to another point, and I think there is a lot of concern on that count, Ms. Kamaneni, because for very long India has been advocating and arguing, you know, global trade, free markets and all of that, and suddenly we've got these import restrictions coming in. Yes, I know it's an inward-looking world, it's insular, America is talking America first, there is a global trade war that's on, but is this the most elegant way to handle global trade? Is this perhaps the most pragmatic approach? Because we could be accused of double-speak here.
I completely agree with you. I think this is the time that we should be opportunistic while, you know, and step in many places, you know, where China there is going to struggle with export because of tariffs. And this is the time that India really, Indian businesses, because you can't defend the rupee at any level. You can't defend our dwindling foreign reserves unless you earn more. You have to open up those channels of earning, and I think this is the time when you're seeing export markets that are doing quite well. India should step in, and we should find all the resources, and that should come in from services. We probably are not doing enough in tourism and medical value travel coming to India. These are things I know directly, but we should be thinking more in terms of what are the service exports, manufacturing exports, and where we can play in spaces that China has been strong, because this is an opportunity. Also, we have not negotiated any new FTAs. We need to see some of these. The markets will react positively when they see an opening in foreign trade channels, and maybe that's coming next. Maybe this is the first step, and because I don't think that what we saw on Friday is a complete set of reform or a stimulus package. We need to be able to counter a slowing, a depreciating rupee by doing some things that is going to strengthen exports.
Right. But Soumya, I wanted to come in on that. You know, already the DA secretary earlier today and even the finance minister had said that, you know, line ministries have been given items to identify, the non-essential import items to identify. The question really is that the government is weighing on this. And you know, before I come to what is a easier way to do this than just import ban restrictively, you know, at a time when, like Ms. Kamnani was saying, that, you know, we need to step into places. We need to take the positions that China may perhaps be vacating. Aren't we sending a very confused trade policy signal? We want to move the WTO when it concerns other nations. What about our own trading partners? Our tariffs are higher than some of our own trading partners. Are we actually almost letting our trading partners know that, you know, go ahead, hike tariffs even further?
No, I agree with your point that we have a trade war, and I think recently there is a news that the US has rejected India's claim, and India is going to go ahead with a trade tariff on imports from US. So I think that's a matter of serious concerns. But my bigger concern is basically the import restriction which we are talking about. In fact, if I look into the data, petroleum imports, electronic imports, electrical machinery imports and gold imports, these 4 imports accounted for 55% of our total imports in August 2018. And if I look into the gold part and the electronic part, and if I look into the share of China, electronic imports from China, the share, that is more than 30%. So I think even though there is a valid argument that in a situation we should always adhere to free trade, but there is also a justification that we cannot allow India to be a dumping place from imports possibly from China, and that has not reached alarming level yet. Last year it was at alarming levels, it has come off, but there is a tendency that the share, if I was looking to the share today, the share of electronic imports in total imports of India has gone up from 11% in June 2018 to 12.3% in August 2018. So to me that's a cause for worry, and there is no harm that if we are doing a Make in India campaign, why can't we have some amount of restrictions on these imports which are not adding to any value but possibly adding to a conspicuous consumption in the country.
Oh, absolutely. I mean, look at the surge at which our electronic imports have grown, and that's a cause of concern. But Jahangir, if I may move the discussion away from that, and you're a big proponent and you mentioned monetary policy tightening earlier as well. The question really is that how much do you expect monetary policy needs to go, monetary rates need to go up by for some sort of sanity and balance to be restored?
Look, that's a very difficult question to answer. In a time of stress with both domestic and what's happening to international markets and reassessment of emerging market risk, it's very difficult to say where there's a magic number. But I would say that doing it earlier rather than later is far more effective, because the further you delay it, it usually ends up in having to tighten much more than required. Case in point is Turkey. I think if you look at what Turkey did in last week, they moved 650 basis points. We had 500 basis points built in. The consensus was somewhere around 300, and you saw how the lira reacted to it. So I think there is a sense of moving. There is a sense of actually taking actions. How much that is, again, very difficult to say. But in situations like these, doing it instead of waiting it till October to doing it now is far more effective in trying to bring down the risk premium that the market is actually demanding out of India and other current account deficit countries. And the lesson is the same for all current account deficit countries.
Risk premium set aside, but I think it's going to have an immediate impact on how corporate India is going to work and the kind of borrowing and lending. Ms. Kamnani, if I may come to you, many people believe a monetary rate hike is given in October, if not before that. How is it going to impact fundraising by Indian industry? I mean, we're just seeing nascent, very, very nascent signs of recovery.
I can't say that it won't impact. It'll 100% impact. Even though we have strong consumption, what have we been doing? We've been creating more and more efficiency. I think this will go on. And we also lose an opportunity for exports, because money is fungible. Indian businesses can easily create global manufacturing presence, but we want it to be in India. So we have to create the right climate, not only for what we can do for the Indian market, for the domestic, but also for the export. And I think this is a big concern, that while we look at, policies, we have to also look at practicality and see what is it that we need to open up those levers. And so as I see opportunities, I see tons of challenges, especially if we're going to have a weak rupee, you're going to have expensive fuel, and then even if the interest rates and access to them are going to be difficult, it's really not the best of scenarios that people are going to start fresh investments. So we have to open up and think that through very carefully, probably the subject of your next debate.
Oh, absolutely. I think it's probably a subject of the next debate, and I will lock in my guest right here. And Ms. Kamini, you'll have to come back to us when we discuss that. But Soumya, very quickly, a last word then. The Finance Minister has once again reiterated his government's commitment of meeting the 3.3% deficit. He's obviously not budging into this whole clamor of a fuel price cut. How confident are you that the government will be able to meet 3.3? Because there are many others who've red flagged our ability to do so.
No, I agree with the point. I think while I heartily welcome the government's holding on to no exercise cuts even in the year when the elections are due, I think that's a very welcome move. But I think the 3.3% deficit this year is challenging because GST is still in a structural transformation phase. The run rate is less than 1 lakh crore. The actual run rate should be around 1.5 lakh crores. So it is around 94-95 lakh crores for the last 3 to 4 months. There has been also some announcement on the MSP front, which will act as additional cost. There is also a cost on the sugarcane front. So, and this investment is only going to start from November. So I think that fiscal deficit picture looks a little bit challenging at this point of time.
Okay, fiscal deficit situation looks a little challenging. The rupee is not really mending its ways. Attempts to reboot perhaps will have to be continuously made. But on that note, thank you very, very much, Ms. Shobhana Kamineni, Jahangir Aziz and Soumyakanti Ghosh for joining us on this edition of the India Development Debate. There is one thing that's certain, that the government wants to be seen taking calls. The government wants to be seen in command. The government wants to be seen as a proactive government. The only trouble is that if you react too much, you send out a signal that you are in panic mode. If you react too much, you risk sending out a signal that you are worried with what's happening. And the reality of the rupee doesn't just mirror India's own macroeconomy, it mirrors global tremors as well. And on that count, it's good to have a vigilant government, but acting too much and too hastily may not serve our purpose very well. The markets and the rupee are still not very certain about the impact of the moves made. We hope sanity will revert soon. Thank you very much for being with us.